Welcome to World Revolution. Dear friends, today we will summarize the book Get Good with Money, 10 Simple Steps to Becoming Financially Whole by Tiffany Aliche. In Get Good with Money, Tiffany Aliche, also known as the Budgetnista, provides a comprehensive guide to achieving financial security and independence. The book is structured around 10 simple steps that Aliche refers to as the 10-step plan for financial wholeness. Let's dive into the overview and some examples to illustrate her approach. #overview. Tiffany Aliche begins by sharing her personal journey with money, which is both inspiring and relatable. She grew up in a financially struggling family and faced significant financial challenges herself, including losing her job during the 2008 financial crisis. These experiences motivated her to learn everything she could about personal finance and eventually share her knowledge with others. The core of the book is the concept of financial wholeness, which Aliche defines as achieving a balanced and healthy relationship with money. Unlike the idea of getting rich quickly, financial wholeness is about creating a sustainable and stress-free financial life. Aliche emphasizes that financial wholeness is achievable for everyone, regardless of their starting point. Key concepts and examples. 1. Budget building. Aliche stresses the importance of creating a budget as the foundation of financial health. She provides a step-by-step guide to tracking income and expenses, categorizing spending, and setting realistic financial goals. For example, she suggests using the 50/30/20 rule, where 50% of income goes to needs, 30% to wants, and 20% to savings and debt repayment. 2. Savings. Building an emergency fund is a critical step in Aliche's plan. She recommends starting with a small, manageable goal, such as saving $500, and gradually increasing it to cover 3 to 6 months of living expenses. Aliche shares stories of individuals who were able to avoid financial disaster by having an emergency fund in place. 3. Debt management. Aliche provides practical strategies for paying off debt, such as the snowball method, where you focus on paying off the smallest debts first to build momentum. She also discusses negotiating with creditors to lower interest rates and create manageable payment plans. One example she gives is of a client who successfully negotiated a lower interest rate on her credit card, saving hundreds of dollars in interest payments. 4. Credit building. Understanding and improving your credit score is another crucial aspect of financial wholeness. Aliche explains how credit scores are calculated and offers tips for improving them, such as paying bills on time and reducing credit card balances. She shares the story of a young woman who raised her credit score by over 100 points in a year by following these tips. 5. Investing. Aliche demystifies investing by explaining the basics of stocks, bonds, and mutual funds. She encourages readers to start investing early, even with small amounts, to take advantage of compound interest. An example she provides is of a couple who started investing $50 a month and saw their investments grow significantly over time. 6. Insurance. Protecting yourself and your assets with the right insurance is another key step. Aliche covers different types of insurance, including health, life, and property insurance, and explains how to choose the right policies. She shares a story of a family who avoided financial ruin after a medical emergency because they had adequate health insurance. 7. Net worth tracking. Aliche emphasizes the importance of knowing your net worth, which is the difference between your assets and liabilities. She provides tools and worksheets to help readers calculate and track their net worth over time. One example is of a man who used Aliche's net worth tracking method to identify areas where he could cut expenses and increase savings. 8. Financial team building. Building a financial support system is crucial for long-term success. Aliche advises readers to seek out financial advisors, accountants, and other professionals who can provide guidance and support. She shares the story of a woman who built a team of trusted advisors and saw significant improvements in her financial situation. 9. Estate planning. Planning for the future is an essential part of financial wholeness. Aliche covers the basics of estate planning, including creating a will, setting up trusts, and designating beneficiaries. She provides an example of a couple who created an estate plan to ensure their children would be taken care of in the event of their passing. 10. Giving back. Finally, Aliche highlights the importance of giving back to the community. She encourages readers to find ways to contribute, whether through donations, volunteering, or mentoring others. She shares the story of a man who found fulfillment and purpose by starting a financial literacy program in his community. Get Good with Money is more than just a financial guide, it's a roadmap to achieving a balanced and fulfilling life. Tiffany Aliche's practical advice, combined with real-life examples, makes the book accessible and inspiring. By following her 10-step plan for financial wholeness, readers can take control of their finances and build a secure future. 10 steps for becoming financially whole. 1. Step number 1, build a budget and automate it. Actively take control of your budget. Think of this as a say-yes step towards your dreams. A good budget will lay out the path towards your prosperous future. Understanding your financial baseline. Aliche begins by emphasizing the importance of understanding your financial baseline, which she refers to as your noodle budget. This is the bare minimum amount of money you need to cover your essential expenses each month. The term noodle budget comes from the idea of living on a simple, inexpensive diet like ramen noodles if necessary. This budget includes only the essentials: housing, utilities, groceries, transportation, and minimum debt payments. Example: imagine Sarah, a young professional who recently graduated from college. Sarah calculates her noodle budget and finds that she needs $1,500 per month to cover her rent, utilities, groceries, and transportation. By knowing this number, Sarah can ensure she always has enough to cover her basic needs, even if her income fluctuates. Creating a comprehensive budget. Once you have your noodle budget, Aliche guides you through creating a comprehensive budget that includes all your expenses, both essential and discretionary. She recommends using the 50/30/20 rule as a guideline. 50% for needs. These are your essential expenses, such as rent, utilities, groceries, and transportation. 30% for wants. These are non-essential expenses, such as dining out, entertainment, and hobbies. 20% for savings and debt repayment. This portion goes towards building your savings and paying down debt. Example: Sarah's monthly income is $3,000. Using the 50/30/20 rule, she allocates $1,500, 50%, for her needs, $900, 30%, for her wants, and $600, 20%, for savings and debt repayment. This structure helps Sarah manage her money effectively and ensures she is saving for the future while enjoying her present. Automating your finances. Aliche strongly advocates for automating your finances to make budgeting easier and more consistent. This involves setting up automatic transfers to your savings account, automating bill payments, and using budgeting apps to track your spending. Example: Sarah sets up an automatic transfer of $300 from her checking account to her savings account every payday. She also automates her utility and credit card payments to avoid late fees and ensure her bills are paid on time. By automating these processes, Sarah reduces the risk of missing payments and makes saving a habit. Tracking and adjusting your budget. Building a budget is not a one-time task, it requires regular tracking and adjustments. Aliche recommends reviewing your budget monthly to ensure you are staying on track and making necessary adjustments based on changes in your income or expenses. Example: after a few months, Sarah notices that she is consistently overspending on dining out. She decides to adjust her budget by reducing her dining out allowance and reallocating that money towards her savings. This adjustment helps her stay within her budget and continue progressing towards her financial goals. By following Tiffany Aliche's step-by-step approach to building a budget, individuals can gain a clear understanding of their financial situation, create a realistic spending plan, and develop habits that lead to financial stability and growth. The process of building a budget, as outlined in Get Good with Money, is not just about managing money, It's about creating a foundation for a financially secure and fulfilling life. 2. Step number 2, get good at saving, for protection. Savings are rocket fuel for your future. They are also a cushion for unpredictabilities. Save not to spend money in the future, but to make more money as well. The importance of saving. Aliche begins by highlighting why saving is essential. Savings act as a financial cushion that can protect you from unexpected expenses, job loss, or emergencies. It also provides the foundation for achieving long-term financial goals, such as buying a home, starting a business, or retiring comfortably. Example, consider John, who unexpectedly lost his job. Because he had built a solid emergency fund, he was able to cover his living expenses for several months while he searched for a new job. This financial cushion prevented him from going into debt and allowed him to focus on finding the right job rather than taking the first one that came along. Setting savings goals. Aliche advises readers to set clear and specific savings goals. These goals should be categorized into 3 main types. 1. Emergency savings. This fund should cover 3 to 6 months of essential living expenses. It's meant to be used only for true emergencies, such as medical bills, car repairs, or job loss. 2. Goal-based savings. These are for specific short-term and medium-term goals, such as a vacation, a new car, or a down payment on a house. 3. Long-term savings. This includes retirement savings and other long-term financial goals. Example, Sarah wants to save for a vacation, a new car, and her retirement. She sets up separate savings accounts for each goal and automates monthly transfers to these accounts. By doing this, she ensures that she is consistently working towards her goals without having to think about it every month. Automating savings. One of Aliche's key strategies is to automate savings. By setting up automatic transfers from your checking account to your savings accounts, you can ensure that you save consistently without having to rely on willpower. Example, Emily sets up an automatic transfer of $200 from her checking account to her emergency savings account every month. She also automates transfers to her retirement account and her goal-based savings accounts. This automation helps her build her savings effortlessly and ensures that she prioritizes saving before spending. Finding money to save. Aliche provides practical tips for finding extra money to save. This includes cutting unnecessary expenses, negotiating bills, and finding additional sources of income. She encourages readers to review their spending habits and identify areas where they can cut back. Example, Mark reviews his monthly expenses and realizes he is spending a significant amount on dining out. He decides to cook more meals at home and saves an extra $150 each month. He redirects this money to his savings accounts, accelerating his progress towards his financial goals. Building an emergency fund. Aliche emphasizes the importance of building an emergency fund as a top priority. She suggests starting with a small, manageable goal, such as saving $500, and gradually increasing it until it covers 3 to 6 months of living expenses. Example, Lisa starts by saving $500 in her emergency fund. Once she reaches this goal, she continues to save until she has enough to cover 3 months of her essential expenses. This fund gives her peace of mind, knowing she has a financial safety net in case of emergencies. Step number 2, get good at saving, is about creating a strong savings habit that can provide financial security and help you achieve your goals. By setting clear savings goals, automating your savings, finding extra money to save, and building an emergency fund, you can take control of your financial future. Tiffany Aliche's practical advice and real-life examples make this step accessible and achievable for everyone. 3. Step number 3, dig out of debt, with an effective plan. Debt is not good, but being debt-free is not your goal. You want to reduce and eliminate your debt, so you can have more money to go towards growing your wealth. Understanding your debt. Aliche begins by emphasizing the importance of getting a clear picture of your debt. This involves listing all your debts, including the amount owed, interest rates, minimum payments, and due dates. By having a comprehensive view of your debt, you can create a strategic plan to tackle it. Example, imagine Maria, who has several debts, including credit card balances, a car loan, and student loans. She creates a spreadsheet listing each debt, the amount owed, the interest rate, and the minimum payment. This helps her understand the full scope of her debt and prioritize which debts to tackle first. Choosing a debt repayment strategy. Aliche introduces two popular debt repayment strategies, the snowball method and the avalanche method. Snowball method. This strategy involves paying off the smallest debts first to build momentum and motivation. Once a small debt is paid off, you move on to the next smallest debt, and so on. Avalanche method. This strategy focuses on paying off debts with the highest interest rates first, which can save you more money in the long run. Example, Maria decides to use the snowball method. She has a small credit card debt of $500, a car loan of $5,000, and student loans totaling $20,000. She focuses on paying off the $500 credit card debt first. Once that is paid off, she uses the money she was paying towards the credit card to tackle the car loan, and so on. This approach helps her stay motivated as she sees her debts disappearing one by one. Automating your debt payments. Aliche strongly advocates for automating debt payments to ensure consistency and avoid missed payments. By setting up automatic payments, you can make sure that your debts are paid on time, which can also help improve your credit score. Example, John has multiple debts and often forgets to make payments on time. He sets up automatic payments for all his debts, ensuring that the minimum payments are made each month. This not only helps him avoid late fees but also improves his credit score over time. Negotiating with creditors. Aliche encourages readers to negotiate with creditors to lower interest rates or create more manageable payment plans. Many creditors are willing to work with you if you explain your situation and ask for help. Example, Emily has a high-interest credit card debt. She calls her credit card company and explains her financial situation. After some negotiation, the company agrees to lower her interest rate from 20% to 15%. This reduction saves her a significant amount of money in interest payments over time. Consolidating debt. For some, consolidating debt into a single loan with a lower interest rate can be an effective strategy. Aliche explains the pros and cons of debt consolidation and provides guidance on how to choose the right consolidation option. Example, David has several high-interest credit card debts. He decides to take out a personal loan with a lower interest rate to pay off his credit card balances. This consolidation simplifies his payments and reduces the amount of interest he pays each month. Step number 3, dig out of debt, is about taking control of your debt and creating a plan to eliminate it. By understanding your debt, choosing a repayment strategy, automating payments, negotiating with creditors, and considering consolidation, you can make significant progress towards financial wholeness. Tiffany Aliche practical advice and real-life examples make this step achievable and empowering for anyone struggling with debt. 4. Step number 4, build your credit score the smart way. Having good credit is a must. It opens doors of opportunity such as home ownership or even getting a good job. You want to grow your credit score. Understanding credit scores. Aliche begins by explaining what a credit score is and why it matters. Your credit score is a numerical representation of your creditworthiness, based on your credit history. It ranges from 300 to 850, with higher scores indicating better credit. The most commonly used credit score is the FICO score, which is calculated based on 5 key factors. 1. Payment history, 35%. This is the most significant factor and reflects whether you pay your bills on time. 2. Amounts owed, 30%. This factor considers your credit utilization ratio, which is the amount of credit you're using compared to your total available credit. 3. Length of credit history, 15%. This looks at how long your credit accounts have been open. 4. Credit mix, 10%. This considers the variety of credit accounts you have, such as credit cards, mortgages, and car loans. 5. New credit, 10%. This factor looks at how many new credit accounts you've opened recently. Example, imagine Jane, who has a credit score of 650. she learns that her score is being dragged down by late payments and high credit card balances. By understanding the factors that affect her score, Jane can create a plan to improve it. Checking your credit report. Aliche emphasizes the importance of regularly checking your credit report to ensure its accuracy. Errors on your credit report can negatively impact your score, so it's crucial to review it and dispute any inaccuracies. Example: John requests his free annual credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion. He discovers an error where a paid-off loan is still listed as outstanding. John disputes the error, and once it's corrected, his credit score improves. Strategies to improve your credit score. Aliche provides several actionable strategies to improve your credit score. 1. Pay bills on time. Consistently paying your bills on time is the most effective way to improve your credit score. Setting up automatic payments can help ensure you never miss a due date. Example: Sarah sets up automatic payments for all her bills, ensuring they are paid on time each month. Over time, her credit score improves as her payment history becomes more positive. 2. Reduce credit card balances. Lowering your credit utilization ratio by paying down credit card balances can significantly boost your score. Aim to keep your credit utilization below 30%. Example: Mark has a credit card with a $10,000 limit and a $7,000 balance. He focuses on paying down his balance to below $3,000, which improves his credit utilization ratio and, consequently, his credit score. 3. Avoid opening new credit accounts. Opening multiple new credit accounts in a short period can negatively impact your score. Be selective about applying for new credit. Example: Emily decides to avoid opening new credit accounts while she works on improving her credit score. This helps her maintain a stable credit history and avoid unnecessary hard inquiries on her report. 4. Keep old accounts open. The length of your credit history matters, so keeping older accounts open can be beneficial. Even if you no longer use an old credit card, keeping it open can positively impact your score. Example: David has an old credit card that he no longer uses. Instead of closing the account, he keeps it open to maintain a longer credit history, which helps improve his credit score. 5. Diversify your credit mix. Having a mix of different types of credit accounts, e.g., credit cards, installment loans, can positively impact your score. Example: Lisa has only credit card accounts. She decides to take out a small personal loan to diversify her credit mix. This addition helps improve her credit score over time. Step number 4, build your credit score, is about understanding the factors that influence your credit score and taking strategic actions to improve it. By regularly checking your credit report, paying bills on time, reducing credit card balances, avoiding unnecessary new credit accounts, keeping old accounts open, and diversifying your credit mix, you can build a strong credit score. Tiffany Aliche practical advice and real-life examples make this step accessible and achievable for anyone looking to improve their financial health. 5. Step number 5, learn to earn, increase your income. One of the best ways to get good with money is to increase your take-home pay. Start earning more intentionally, and lots of good things will follow. Assessing your current income. Aliche begins by encouraging readers to take a close look at their current income. This involves understanding how much you earn, where it comes from, and how it aligns with your financial goals. She suggests listing all sources of income, including your primary job, side gigs, and any passive income streams. Example: imagine Alex, who works as a graphic designer. He lists his primary income from his full-time job, a small amount from freelance projects, and some passive income from stock dividends. By understanding his total income, Alex can better plan how to increase it. Asking for a raise. One of the most direct ways to increase your income is by asking for a raise at your current job. Aliche provides a step-by-step guide on how to prepare for this conversation. She advises documenting your contributions and achievements, researching industry salary standards, and practicing your pitch. Example: Sarah has been working at her company for 3 years and feels she deserves a raise. She compiles a list of her accomplishments, such as leading successful projects and improving team efficiency. Armed with this information and industry salary data, Sarah confidently asks her boss for a raise and successfully negotiates a 10% increase in her salary. Exploring side hustles. Aliche encourages readers to explore side hustles as a way to supplement their income. She suggests identifying skills and passions that can be monetized and looking for opportunities that fit into your schedule. Side hustles can range from freelance work and consulting to selling handmade goods or offering tutoring services. Example: John enjoys photography and decides to turn his hobby into a side hustle. He starts offering photography services for events and selling prints online. Over time, his side hustle grows, providing him with an additional stream of income that helps him pay off debt and save for future goals. Investing in yourself. Investing in your education and skills can lead to higher earning potential. Aliche recommends taking courses, attending workshops, and seeking certifications that can enhance your qualifications and open up new career opportunities. Example: Emily works in marketing and wants to advance her career. She enrolls in a digital marketing certification program and learns new skills in social media advertising and SEO. With her new qualifications, Emily applies for a higher-paying position at a different company and secures the job, significantly increasing her income. Creating passive income streams. Aliche also highlights the importance of creating passive income streams, which can provide ongoing earnings with minimal effort. This can include investments in stocks, real estate, or starting a business that generates residual income. Example: David invests in rental properties and earns passive income from the monthly rent payments. He also invests in dividend-paying stocks, which provide him with regular dividend income. These passive income streams supplement his primary income and contribute to his long-term financial security. Step number 5, Learn to Earn, is about actively seeking ways to increase your income to achieve financial wholeness. By assessing your current income, asking for a raise, exploring side hustles, investing in yourself, and creating passive income streams, you can boost your earnings and accelerate your financial goals. Tiffany Aliche practical advice and real-life examples make this step accessible and achievable for anyone looking to improve their financial situation. 6. Step number 6. Invest like an insider, for retirement. The goal of investing for retirement is to have enough money to maintain your current lifestyle after you stop working. To achieve that, invest consistently. Understanding the basics of investing. Aliche begins by explaining the fundamental concepts of investing. She emphasizes that investing is not just for the wealthy, it's a powerful tool that anyone can use to build wealth over time. She breaks down the different types of investments, including stocks, bonds, mutual funds, and real estate, and explains how each one works. Example: Imagine Lisa, who is new to investing. She learns from Aliche that stocks represent ownership in a company and can provide high returns but come with higher risk. Bonds, on the other hand, are loans to companies or governments that pay interest over time and are generally considered safer but offer lower returns. By understanding these basics, Lisa feels more confident about starting her investment journey. Setting investment goals. Aliche stresses the importance of setting clear investment goals. These goals should be specific, measurable, achievable, relevant, and time-bound, smart. She encourages readers to think about what they want to achieve with their investments, whether it's saving for retirement, buying a home, or funding a child's education. Example: John wants to save for his retirement. He sets a goal to have $500,000 in his retirement account by the time he turns 65. By setting this specific goal, John can create a plan to achieve it, including how much he needs to invest each month and what types of investments will help him reach his target. Creating an investment plan. Once you have your goals, Aliche guides you through creating an investment plan. This involves determining your risk tolerance, choosing the right mix of investments, and deciding how much to invest regularly. She emphasizes the importance of diversification, which means spreading your investments across different asset classes to reduce risk. Example: Sarah has a moderate risk tolerance. She decides to create a diversified portfolio that includes 60% stocks, 30% bonds, and 10% real estate. By diversifying her investments, Sarah can balance potential returns with her comfort level for risk. Using retirement accounts. Aliche highlights the benefits of using retirement accounts, such as 401(k)s and IRAs, to invest for the future. These accounts offer tax advantages that can help your investments grow more efficiently. She explains the differences between traditional and Roth accounts and how to choose the right one based on your financial situation. Example: Emily decides to open a Roth IRA because she expects to be in a higher tax bracket when she retires. By contributing to a Roth IRA, she can enjoy tax-free withdrawals in retirement, which will help her maximize her retirement income. Automating your investments. Aliche strongly advocates for automating your investments to ensure consistency and take advantage of dollar-cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of market conditions. Over time, this can help reduce the impact of market volatility and build wealth steadily. Example: David sets up an automatic monthly transfer of $200 from his checking account to his investment account. By automating his investments, David ensures that he consistently contributes to his portfolio and takes advantage of dollar-cost averaging. Seeking professional advice. While Aliche provides a wealth of information to help readers get started with investing, she also acknowledges the value of seeking professional advice. She encourages readers to consult with a certified financial planner or investment advisor to create a personalized investment plan and get expert guidance. Example: Mark feels overwhelmed by the complexities of investing. He decides to meet with a certified financial planner who helps him create a tailored investment strategy based on his goals, risk tolerance, and financial situation. With professional guidance, Mark feels more confident about his investment decisions. Step number 6, Invest Like an Insider, is about empowering readers to take control of their financial future through smart investing. By understanding the basics of investing, setting clear goals, creating a diversified investment plan, using retirement accounts, automating investments, and seeking professional advice, you can build wealth and achieve financial wholeness. Tiffany Aliche's practical advice and real-life examples make this step accessible and achievable for anyone looking to grow their wealth strategically. 7. Step number 7, Use insurance to manage risks. Insurance is tricky. It will feel like a waste of money until you need it, but the reality is life is unpredictable. You absolutely do need insurance to manage the risks. Understanding the role of insurance. Aliche begins by explaining the fundamental role of insurance, to provide financial protection against unexpected events. Insurance can help cover the costs associated with accidents, illnesses, property damage, and even death. By having the right insurance coverage, you can safeguard your financial stability and avoid significant financial setbacks. Example: Imagine Jane, who owns a home and has a family. Without insurance, a major event like a house fire or a serious illness could devastate her finances. With the right insurance policies in place, Jane can ensure that she and her family are protected from such financial disasters. Types of insurance. Aliche outlines several key types of insurance that everyone should consider. 1. Health insurance. This is essential for covering medical expenses, including doctor visits, hospital stays, and prescription medications. Health insurance can help prevent medical bills from becoming a financial burden. Example: John has health insurance through his employer. When he unexpectedly needs surgery, his insurance covers the majority of the costs, saving him thousands of dollars in medical bills. 2. Life insurance. Life insurance provides financial support to your beneficiaries in the event of your death. It can help cover funeral expenses, pay off debts, and provide for your family's future needs. Example: Sarah, a single mother, purchases a life insurance policy to ensure that her children will be financially secure if something happens to her. The policy provides peace of mind, knowing her children will be taken care of. 3. Disability insurance. This type of insurance provides income replacement if you are unable to work due to a disability. It can help cover living expenses and maintain your standard of living during periods of disability. Example, Mark, a construction worker, buys disability insurance. When he suffers a serious injury that prevents him from working, his disability insurance provides a portion of his income, allowing him to focus on recovery without financial stress. 4. Property insurance. Property insurance, including homeowners and renters insurance, protects your home and belongings from damage or loss due to events like fire, theft, or natural disasters. Example, Emily's apartment is damaged by a fire. Her renter's insurance covers the cost of replacing her damaged belongings and provides temporary housing while her apartment is being repaired. 5. Auto insurance. Auto insurance covers the costs associated with car accidents, including vehicle repairs, medical expenses, and liability for damages to others. Example, David is involved in a car accident. His auto insurance covers the repair costs for his car and the medical expenses for the other driver, preventing a significant financial burden. Calculating your insurance needs. Aliche provides guidance on how to calculate your insurance needs. This involves assessing your financial situation, understanding the potential risks you face, and determining the appropriate coverage amounts. She emphasizes the importance of not being underinsured, as inadequate coverage can leave you vulnerable to financial hardship. Example, Lisa reviews her financial situation and determines that she needs $500,000 in life insurance coverage to ensure her family's financial security. She also calculates that she needs enough health insurance to cover potential medical expenses and sufficient property insurance to replace her home and belongings in case of a disaster. Shopping for insurance. Aliche advises readers to shop around for insurance policies to find the best coverage at the most affordable rates. She recommends comparing quotes from multiple insurers, reading policy details carefully, and seeking advice from insurance professionals if needed. Example, Alex is looking for auto insurance. He compares quotes from several insurance companies, reads customer reviews, and consults with an insurance agent. By doing his research, Alex finds a policy that offers comprehensive coverage at a reasonable price. Step number 7, use insurance, is about understanding the importance of insurance and making informed decisions to protect yourself and your assets. By learning about different types of insurance, calculating your coverage needs, and shopping for the best policies, you can ensure that you are financially protected against unexpected events. Tiffany Aliche practical advice and real-life examples make this step accessible and achievable for anyone looking to secure their financial future. 8. Step number 8, establish net worth goals, and grow. Net worth, your assets less your liabilities, can and should be tracked all the time. Make decisions which will nudge it in the right direction every day. Understanding net worth. Aliche begins by explaining what net worth is and why it matters. Your net worth is the difference between your assets, what you own, and your liabilities, what you owe. It provides a snapshot of your overall financial health and can help you measure your progress towards financial goals. Example, imagine Lisa, who owns a home worth $300,000, has $50,000 in savings, and $20,000 in investments. She also has a mortgage of $200,000 and $10,000 in credit card debt. Lisa's net worth is calculated as follows. $text, net worth equals \text, assets, \text, liabilities equals 300,000 plus 50,000 plus 20,000, 200,000 plus 10,000 equals 360,000, 210,000 equals $150,000. Lisa's net worth is $150,000, which gives her a clear picture of her financial standing. Setting net worth goals. Aliche emphasizes the importance of setting specific, measurable, achievable, relevant, and time-bound, SMART, net worth goals. These goals can help you stay focused and motivated as you work towards improving your financial situation. Example, John sets a goal to increase his net worth by $50,000 over the next 5 years. He breaks this down into smaller, manageable steps, such as paying off $10,000 in debt, saving an additional $20,000, and investing $20,000. By setting a clear goal and outlining the steps to achieve it, John can track his progress and stay motivated. Tracking your net worth. Aliche advises readers to regularly track their net worth to monitor their financial progress. She suggests creating a net worth statement, which lists all assets and liabilities, and updating it periodically. This practice helps you see how your financial decisions impact your overall wealth. Example: Emily creates a net worth statement and updates it every quarter. She notices that her net worth increases when she pays down debt and contributes to her savings and investment accounts. This regular tracking helps Emily stay on top of her finances and make informed decisions. Strategies to increase net worth. Aliche provides several strategies to help readers increase their net worth. 1. Pay down debt. Reducing liabilities is a direct way to increase net worth. Focus on paying off high-interest debt first to save on interest payments and free up more money for savings and investments. Example: Mark has $15,000 in credit card debt with a high interest rate. He prioritizes paying off this debt, which reduces his liabilities and increases his net worth. 2. Increase savings. Building up your savings can boost your net worth. Set up automatic transfers to your savings account to ensure consistent contributions. Example: Sarah sets up an automatic transfer of $200 from her checking account to her savings account each month. Over time, her savings grow, contributing to an increase in her net worth. 3. Invest wisely. Investing in assets that appreciate over time, such as stocks, real estate, or retirement accounts, can significantly boost your net worth. Diversify your investments to manage risk and maximize returns. Example: David invests in a diversified portfolio of stocks and bonds. Over the years, his investments grow, increasing his net worth. 4. Increase income. Finding ways to boost your income, such as asking for a raise, starting a side hustle, or investing in education to advance your career, can provide more money to save and invest. Example: Lisa starts a side business selling handmade crafts. The additional income allows her to pay off debt faster and invest more, increasing her net worth. Step number 8, establish net worth goals, is about understanding your financial position and taking strategic actions to improve it. By calculating your net worth, setting SMART goals, tracking your progress, and implementing strategies to increase your assets and reduce your liabilities, you can steadily grow your wealth. Tiffany Aliche practical advice and real-life examples make this step accessible and achievable for anyone looking to enhance their financial health. 9. Step number 9, pick your money team, financial pros. To really achieve your financial goals, you're going to need a team of advisors to help you get there. Take the time to assemble a team of A players and professionals. The importance of a money team. Aliche begins by explaining why having a money team is crucial. Managing finances can be complex and challenging, and having a team of experts and supportive individuals can help you make informed decisions, stay motivated, and achieve your financial goals. Your money team can provide different perspectives, hold you accountable, and offer specialized knowledge that you might not have. Example: Imagine Sarah, who is trying to navigate her finances alone. She often feels overwhelmed and unsure about her decisions. By building a money team, Sarah gains access to expert advice and support, which helps her feel more confident and capable in managing her finances. Key members of your money team. Aliche outlines several key members who should be part of your money team. 1. Financial advisor. A financial advisor can help you create a comprehensive financial plan, set goals, and make investment decisions. They provide personalized advice based on your financial situation and goals. Example: John meets with a certified financial planner who helps him create a retirement plan, diversify his investments, and set up a college savings fund for his children. With the advisor's guidance, John feels more secure about his financial future. 2. Accountant. An accountant can assist with tax planning, preparation, and filing. They can also help you understand the tax implications of your financial decisions and identify opportunities for tax savings. Example: Emily hires an accountant to help her with her taxes. The accountant identifies several deductions and credits that Emily was unaware of, resulting in significant tax savings. 3. Insurance agent. An insurance agent can help you assess your insurance needs and find the right policies to protect yourself and your assets. They can explain the different types of insurance and ensure you have adequate coverage. Example: David consults with an insurance agent who reviews his current policies and recommends additional coverage for his home and car. The agent helps David find the best policies at competitive rates. 4. Attorney. An attorney can provide legal advice and services related to estate planning, wills, trusts, and other legal matters. They can help you protect your assets and ensure your wishes are carried out. Example: Lisa works with an estate planning attorney to create a will and set up a trust for her children. The attorney ensures that Lisa's assets will be distributed according to her wishes and that her children will be taken care of. 5. Mentor or coach. A mentor or financial coach can provide guidance, support, and accountability as you work towards your financial goals. They can share their experiences and offer practical advice based on their own financial journey. Example: Mark connects with a financial coach who helps him create a budget, set savings goals, and develop a debt repayment plan. The coach provides ongoing support and encouragement, helping Mark stay on track. Building your money team. Aliche provides practical advice on how to build your money team. She suggests starting by identifying your financial needs and goals, then seeking out professionals who have the expertise to help you achieve them. She also emphasizes the importance of choosing team members who are trustworthy, experienced, and have a good reputation. Example: Sarah starts by identifying her financial goals, such as saving for a home, paying off debt, and planning for retirement. She then seeks recommendations from friends and family for a financial advisor, accountant, and insurance agent. After interviewing several candidates, Sarah selects professionals who she feels comfortable with and who have a proven track record of success. Maintaining your money team. Aliche advises readers to maintain regular communication with their money team and to review their financial plans periodically. This ensures that your team is aware of any changes in your financial situation and can provide updated advice and support. Example: Emily schedules annual reviews with her financial advisor, accountant, and insurance agent. During these meetings, she discusses any changes in her financial situation, updates her goals, and receives advice on any necessary adjustments to her financial plan. Step number 9, Pick Your Money Team, is about building a network of knowledgeable and trustworthy individuals who can provide guidance and support as you work towards financial wholeness. By identifying your financial needs, selecting the right professionals, and maintaining regular communication, you can create a strong support system that helps you achieve your financial goals. Tiffany Aliche practical advice and real-life examples make this step accessible and achievable for anyone looking to enhance their financial health. 10. Step number 10, Leave a legacy, smart estate planning. The final step in becoming financially whole is to figure out what kind of legacy you want to leave. What do you want to happen to the wealth you're trying to create? The importance of estate planning. Aliche begins by emphasizing the importance of estate planning. Estate planning involves creating a plan for the management and distribution of your assets after your death. This step is crucial because it ensures that your loved ones are taken care of and that your assets are distributed according to your wishes. Without a proper estate plan, your assets could be subject to lengthy legal processes and disputes. Example: Imagine Jane, who has worked hard to build a substantial estate, including a home, investments, and personal belongings. Without an estate plan, her assets could be tied up in probate court, causing stress and financial hardship for her family. By creating an estate plan, Jane can ensure that her assets are distributed smoothly and according to her wishes. Key components of an estate plan. Aliche outlines several key components that should be included in a comprehensive estate plan. 1. Will. A will is a legal document that outlines how you want your assets to be distributed after your death. It can also designate guardians for minor children and specify your wishes for funeral arrangements. Example: John creates a will that specifies how his assets, including his home, savings, and personal belongings, should be distributed among his family members. He also names a guardian for his young children, ensuring they will be cared for by someone he trusts. 2. Trust. A trust is a legal arrangement that allows you to transfer assets to a trustee, who manages them on behalf of your beneficiaries. Trusts can help avoid probate, provide privacy, and offer more control over how and when your assets are distributed. Example: Sarah sets up a trust to manage her assets and provide for her children's education and future needs. By using a trust, Sarah ensures that her assets are managed according to her wishes and that her children receive financial support at appropriate times. 3. Power of attorney. A power of attorney is a legal document that grants someone the authority to make financial and legal decisions on your behalf if you become incapacitated. Example: David appoints his sister as his power of attorney. If David becomes unable to manage his finances due to illness or injury, his sister can step in and handle his financial affairs, ensuring that his bills are paid and his assets are protected. 4. Healthcare directive. A healthcare directive, also known as a living will, outlines your wishes for medical treatment if you become unable to communicate them yourself. It can also designate a healthcare proxy to make medical decisions on your behalf. Example: Emily creates a healthcare directive that specifies her wishes for end-of-life care and appoints her best friend as her healthcare proxy. This ensures that her medical preferences are respected and that someone she trusts is making decisions on her behalf. Taking inventory of your assets. Aliche advises readers to take a thorough inventory of their assets, including real estate, investments, bank accounts, personal property, and valuable possessions. This inventory will help you understand the full scope of your estate and ensure that all assets are accounted for in your estate plan. Example: Lisa creates a detailed list of her assets, including her home, retirement accounts, jewelry, and artwork. This inventory helps her and her attorney create a comprehensive estate plan that covers all her assets. Working with professionals. Aliche emphasizes the importance of working with professionals, such as estate planning attorneys and financial advisors, to create and implement your estate plan. These experts can provide valuable guidance, ensure that your documents are legally sound, and help you navigate complex legal and financial issues. Example: Mark consults with an estate planning attorney to draft his will and set up a trust. The attorney helps Mark understand the legal requirements and ensures that his estate plan is comprehensive and legally binding. Communicating your wishes. Aliche encourages readers to communicate their estate planning wishes with their loved ones. This can help prevent misunderstandings and conflicts and ensure that everyone is aware of your plans. Example: John holds a family meeting to discuss his estate plan with his children. He explains his decisions and answers their questions, ensuring that they understand his wishes and the reasons behind them. Step number 10, Leave a Legacy, is about ensuring that your financial achievements and assets are preserved and passed on according to your wishes. By creating a comprehensive estate plan that includes a will, trust, power of attorney, and healthcare directive, taking inventory of your assets, working with professionals, and communicating your wishes, you can leave a lasting legacy for your loved ones. Tiffany Aliche practical advice and real-life examples make this step accessible and achievable for anyone looking to secure their financial future and provide for their family. Conclusion. Aliche's conclusion emphasizes the concept of financial wholeness, which is the overarching theme of the book. Financial wholeness is about achieving a balanced and healthy relationship with money, where all aspects of your financial life are in harmony. This includes budgeting, saving, investing, managing debt, and planning for the future. Aliche stresses that financial wholeness is not about perfection but about progress and consistency. Example: Imagine Sarah, who has followed Aliche's 10-step plan. She has created a budget, built an emergency fund, paid down her debt, improved her credit score, started investing, and set up an estate plan. While Sarah's financial journey is ongoing, she feels more confident and secure knowing that she has a solid foundation and a clear path forward. The power of small steps. Aliche encourages readers to recognize the power of small, consistent steps in achieving financial wholeness. She reminds readers that significant financial changes don't happen overnight but through steady, incremental progress. Each small step, whether it's saving a little more each month or paying off a small debt, contributes to the larger goal of financial stability. Example, John started his financial journey by saving just $50 a month. Over time, he increased his savings, paid off his credit card debt, and began investing. These small steps, taken consistently, have led to significant improvements in his financial situation. John now has a healthy emergency fund, a growing investment portfolio, and a clear plan for his financial future. Overcoming financial challenges. Aliche acknowledges that financial challenges are inevitable, but she encourages readers to view these challenges as opportunities for growth and learning. She shares her own experiences of overcoming financial setbacks and emphasizes the importance of resilience and perseverance. Example, Emily faced a significant financial setback when she lost her job. Instead of giving up, she used the skills and strategies she learned from Aliche's book to create a new budget, cut unnecessary expenses, and find a new job. Emily's resilience and determination helped her overcome the setback and continue on her path to financial wholeness. Building a supportive community. Aliche highlights the importance of building a supportive community as part of the journey to financial wholeness. She encourages readers to connect with others who share similar financial goals, whether through online communities, local groups, or financial workshops. Sharing experiences, challenges, and successes with others can provide motivation, accountability, and valuable insights. Example, David joins an online financial community where members share tips, advice, and support. Through this community, David learns new strategies for managing his money, finds encouragement during challenging times, and celebrates his financial milestones with others who understand his journey. Celebrating progress. Finally, Aliche reminds readers to celebrate their progress, no matter how small. Recognizing and celebrating achievements can boost motivation and reinforce positive financial behaviors. She encourages readers to take pride in their accomplishments and to continue striving for financial wholeness. Example, Lisa celebrates each financial milestone, whether it's paying off a credit card, reaching a savings goal, or making her first investment. These celebrations, whether a small treat or a special outing, help Lisa stay motivated and focused on her financial goals. The conclusion of Get Good with Money is a powerful reminder that financial wholeness is a journey, not a destination. Tiffany Aliche's practical advice, personal stories, and actionable steps provide readers with the tools and confidence to take control of their finances and build a secure and fulfilling financial future. By embracing the principles of financial wholeness, taking small, consistent steps, overcoming challenges, building a supportive community, and celebrating progress, readers can achieve lasting financial stability and peace of mind. Thank you for listening. I hope this content is useful to you. If you like this kind of content, please like, share, and subscribe to our channel to support our team.